Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section E5. This is a remembering and understanding topic. Identify factors that should be considered while performing planned procedures that may indicate substantial doubt about an entity's ability to continue as a going concern for a reasonable period of time. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it is free and it is only 1 hour long, and we will teach you the key ingredients to passing the CPA exam in that 1 hour. So make sure you don't miss that. Go check it out. After that, you're going to want to learn more. So make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full 10-question versions of these 5-question YouTube videos. So in today's video, we're only going to be going over 5 questions, but again, Pro members will get access to the full 10-question version so that they can get a little bit more help and a little bit more understanding. So remember that if you like this and you like our other videos and our other products, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and let's just dive straight in. Which of the following situations would not typically raise substantial doubt about an entity's ability to continue as a going concern for a reasonable period of time? So which one of these is not something that's going to raise that doubt? Let's go through the options. Option A, the entity is experiencing recurring negative operating cash flows. Option B, the entity has a significant working capital deficiency. Option C, the entity is denied access to customary trade credit from suppliers. Or option D, the entity recently refinanced its long-term debt at a favorable interest rate. So if you don't really know what going concern means, or if you haven't really dealt with that, then you might not really have an idea of what this is talking about. But if you have heard of going concern, then you can kind of probably think through this and think which one makes the most sense to not really be something that would raise a doubt about going concern. Now, again, if you don't know anything about it, that's okay. We're going to use the answer to learn about this. So let's go ahead and talk about the explanation. Okay, here we are at the answer. D, the entity recently refinanced its long-term debt at a favorable interest rate. That's something that's probably not going to make the auditor have a substantial doubt about the entity's ability to continue as a going concern. Let's go through the explanation, kind of learn about going concern and what things typically give a red flag to the auditor that something's wrong. Going concern refers to the assumption that an entity will remain in business and be able to meet its obligations as they come due for at least 1 year from the date the financial statements are issued. So basically, the company is going to be able to run at least for the next year. That's kind of the idea behind going concern. Auditors are required to assess whether there is substantial doubt about the entity's ability to continue operating under this assumption. So let's talk about 3 common factors that could raise this doubt for the auditor. First, recurring negative operating cash flows, which suggests the business is not generating enough internal funds to sustain itself. Next is working capital deficiencies, which indicate the entity may not have enough short-term assets to cover its short-term liabilities. And then finally, denial of customary trade credit. If it's a credit that they typically have access to, but now they're getting denied that, this usually signals a lack of confidence from suppliers and could restrict access to necessary goods or services, meaning that, again, they're probably not doing very good. So the suppliers are like, we can't really give you credit because you're probably not going to be able to pay, or whatever the case is. On the other hand, refinancing long-term debt at a favorable rate typically strengthens the entity's financial position and improves liquidity, thereby reducing concern over going concern issues. So it's kind of the opposite with that one. But that's the general idea behind going concern, and those are some of the common things that are going to raise this concern for auditors. Now let's go to the next question. Okay, here we are at question 2. And one thing I always like to point out if it's an option is to read the last sentence of a question first. It's not always going to be extremely helpful, especially if you only have like a 1 or 2 sentence question, but it is a very good habit to be in anyway, because on test day, you have no idea what the questions are going to be. So if you get to a question and immediately read the last sentence of the question very frequently, that will give you context for what the question is about, or kind of a rough idea about what the question is about. And then you can go through the rest of the question already having that idea and be looking for the answers instead of having to read through the whole thing and not really know what you're dealing with until the very end. So again, this is a very good habit to be in. Let's go ahead and do it right here. Which of the following plans is most likely to reduce the auditor's concern? Let's go up to the top. An auditor identifies events that may cast substantial doubt on an entity's ability to continue as a going concern. Management presents several proposed plans in response. So which of the following plans is most likely to reduce the auditor's concern? So management's trying to fix this. Let's go through the options. Option A, management plans to issue additional equity and has begun discussions with investors. Option B, management plans to rebrand the company in hopes of attracting a younger customer base. Option C, management expects to increase prices significantly despite declining customer retention. Or option D, management is optimistic that the upcoming product launch will generate higher sales. Okay, so what is the one plan that the auditor is probably going to look at and say, yeah, that does reduce the substantial doubt I have about the going concern for this company? Now, you can probably kind of figure that out based on these different options. So if you need to, pause the video, but if not, let's go ahead and take a look at the answer because you probably already have an idea of which one is correct. Okay, here we are. The answer is A, management plans to issue additional equity and has begun discussions with investors. So that's probably the most likely out of these options to reduce the auditor's concern about, the going concern. To address going concern risks, management may develop concrete plans such as raising additional capital or equity, obtaining new financing, restructuring debt, selling assets, or cutting costs. All these things to try to kind of help boost the company's money and boost their ability to take care of their liabilities. These actions directly improve liquidity or reduce financial strain and are considered credible mitigating factors when supported by evidence. So essentially, we're learning about mitigating factors for going concern in this question. So these are things that management can do to reduce the substantial doubt that an auditor has in the going concern of the company. Let's talk about the other options a little bit. Option A reflects a proactive financial strategy with external support and is therefore a legitimate response. That's why that's the correct one. The other options, rebranding, price increases, and product optimism. By the way, does that sound like some companies that are out there these days that are not doing very good? I think that this happens frequently, if I'm being honest. Again, these are more speculative and do not provide a reliable basis for alleviating concern about the company's ability to meet obligations in the near term. So again, we learned about mitigating factors for going concern in this question. Now let's go to the next question. All right, here we are at question 3. How should the auditor respond in the audit report? Let's go up to the top. An auditor identifies conditions that initially raised substantial doubt about an entity's ability to continue as a going concern. After evaluating management's plans, the auditor concludes that the doubt has been alleviated. The financial statements include adequate disclosure of the conditions and management's response. How should the auditor respond in their audit report for this? Let's go through the options. Option A, issue a qualified opinion due to uncertainty regarding the entity's future operations. Option B, issue an unmodified opinion and add an emphasis of matter paragraph describing the situation. Option C, issue an adverse opinion because the entity faced substantial doubt during the period. Or option D, issue a disclaimer of opinion due to uncertainty related to going concern. Now, we haven't talked in these videos about opinions very much. That is one of the last things that you talk about in the blueprint. So we'll get there eventually. I feel like it's kind of backwards in the blueprint. This should have been something that was talked about early on, in my opinion, but whatever. We haven't really talked about these very much, but I feel like you've kind of got an idea if you've watched these videos with me, kind of an idea of what these all kind of mean. So if you know much about different audit opinions, then you might have an idea here. But if not, that's okay. We're going to use the explanation to start learning about this. All right, here we are at the answer. B, issue an unmodified opinion and add an emphasis of matter paragraph describing the situation. So this is what the auditor should do in this situation. Let's kind of walk through this. When substantial doubt existed but was alleviated by management's feasible plans and adequate disclosure is included in the financial statements, the auditor still highlights the issue through an emphasis of matter paragraph, even though the opinion remains unmodified. And remember, unmodified, I've kind of explained this a little bit. Unmodified means that as far as the financial statements being presented fairly, there's not anything that the auditor thinks is, a major issue. There's no material misstatements or things like that. So that would be an unmodified opinion. Now, an emphasis of matter paragraph is basically just pointing something out that they want to emphasize. So this emphasis of matter paragraph, when, they issued an unmodified opinion and the going concern was alleviated, this paragraph needs to refer to the note in the financial statements that describes the matter, and it needs to indicate that the auditor's opinion is not modified in respect to the going concern issue. So they are going to explicitly say this is an unmodified report and it is not going to be modified or affected by the fact that there was a going concern issue because it's been alleviated. Options A, C, and D are incorrect because they all involve modifying the opinion, which is not appropriate when substantial doubt has been alleviated and the disclosures are sufficient. So that's how it works when there's substantial doubt, but then it's alleviated. You still have to kind of mention it and point it out, but you are basically just pointing out that it's been alleviated and kind of refer to it in a note. Now let's go to the next question. All right, here we are at question 4. How should the auditor respond in the audit report? Let's go up to the top. An auditor concludes that substantial doubt exists about an entity's ability to continue as a going concern for a reasonable period of time. Management's plans do not alleviate the concern, but the financial statement disclosures are adequate. How should the auditor respond in the audit report? So this is kind of a similar situation, but instead of management's plan working to alleviate the concern, it didn't work. So what is the auditor going to do in this situation? Let's go through the options. Option A, issue an unmodified opinion with a section titled Substantial Doubt about the entity's ability to continue as a going concern. Option B, issue a qualified opinion due to the unresolved uncertainty. Option C, issue an unmodified opinion and include an emphasis of matter paragraph referring to the going concern note. So that's what you did in the other situation. Is it the same in this one? And then option D, issue a disclaimer of opinion because future outcomes are uncertain. So what is the auditor going to do in a situation where the management plan did not alleviate the doubt about the going concern? Think about this if you want, pause the video, but if not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is A, issue an unmodified opinion with a section titled Substantial Doubt about the entity's ability to continue as a going concern. So let's walk through the explanation. When substantial doubt has not been alleviated and the financial statements include adequate disclosure, so they're still adequately disclosing it, but whatever plan they had did not alleviate the substantial doubt, the auditor still issues an unmodified opinion, but must include a separate section titled Substantial Doubt about the entity's ability to continue as a going concern. This section is required to use the exact phrases substantial doubt and going concern. So those have to be in that section, and it's not an emphasis of matter paragraph, it's an entire separate section talking about this, and it highlights the disclosure for the user of the financial statements. Now let's talk about the other options and why they're not quite correct. Option B is incorrect because a qualified opinion is not necessary if the disclosure is adequate. Option C is outdated. Auditors no longer use a generic emphasis of matter paragraph in this situation under current standards. So maybe if you took the CPA exam a long time ago, that might have been something that was tested, but now it's different. Option D, and that was a disclaimer of opinion, is only appropriate when there is a severe scope limitation or pervasive uncertainty that affects the auditor's ability to obtain sufficient evidence. And that's not the case here because, again, they have adequate disclosure, and it's not that they couldn't get evidence. It's just that management's plan doesn't really alleviate the auditor's concern about the going concern of the company. So what is the auditor going to do? Again, they are going to have a separate section and has that very specific title, Substantial Doubt about the entity's ability to continue as a going concern. And that's the actual title. I'm pretty sure that that's like the actual title that you will see on the exam if you see a question like this. Now with that, we learned a little bit more. Let's go to the next question. All right, here we are at question 5. To whom should the auditor communicate this matter and what should be communicated? Let's go up to the top. An auditor has concluded that substantial doubt exists about an entity's ability to continue as a going concern for a reasonable period of time, and the doubt has not been alleviated by management's plans. The financial statements include adequate disclosure, and the auditor plans to include a going concern section in the audit report. So we just talked about that. But to whom should the auditor communicate this matter and what should be communicated? Let's go through the options. Option A, only to external users by including the going concern section in the audit report. Option B, to those charged with governance, including the auditor's evaluation and related reporting implications. Option C, only to the entity's legal counsel requesting confirmation of financial contingency disclosures. Or option D, to internal audit staff so that they can monitor the risk during the next fiscal year. So again, who are they going to communicate this to? Of course, it's going to be in their report, but also they have to kind of talk to some people about this potentially, or do they? Pause the video, think about this if you want, but if not, that's okay. We're learning from these questions. So let's go ahead and take a look at the explanation together right now. All right, here we are. The answer is B, to those charged with governance, including the auditor's evaluation and related reporting implications. Okay, so let's go through the explanation. When substantial doubt about going concern exists and has not been alleviated, the auditor is required to communicate this in writing to those charged with governance. This communication should include the conditions or events giving rise to the substantial doubt, management's plans, the auditor's evaluation of those plans, and the anticipated effect on the auditor's report. So that would be like the inclusion of a going concern section. They're going to tell them, hey, we're going to include this section. Option A is incomplete because the auditor also has a governance level responsibility, not just a reporting one. Option C is unrelated. Legal counsel is consulted for litigation or contingency disclosures, not going concern. And then option D refers to a party, and that's the internal audit, who is not the proper recipient of formal auditor communication on this matter. They're supposed to be talking to those charged with governance, not the internal audit department. Now, we learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you how an auditor is supposed to react when there is the going concern, the substantial doubt of going concern, but then it's not alleviated. Again, you're seeing this throughout multiple questions trying to teach you about a specific topic. And you write this down in your own words, again, as the most important things, the pillar topics, based on what you learned from the questions. And as you're doing this each day, you're building your own personal repository in your own words of the most important things you learned by doing the questions while you were preparing for the exam. Now with that, let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, going concern indicators. So these are the things that are going to indicate probably a substantial doubt about going concern. Substantial doubt about going concern may arise from conditions such as recurring negative cash flows, working capital deficiencies, and loss of access to normal trade credit. These factors suggest the entity may not be able to meet obligations in the near future. And remember, going concern is from the financial statement date, whether the company can handle their liabilities for the next year. Now let's talk about management's mitigating plans or their mitigating factors. Auditors evaluate whether management's plans, such as raising equity, obtaining financing, restructuring debt, selling assets, or cutting costs, are likely to actually alleviate substantial doubt. The plans must be supported by evidence and reasonably expected to succeed. Now let's talk about reporting when doubt is alleviated. If substantial doubt existed but has been alleviated by management's plans and disclosures are adequate, the auditor may include an optional emphasis of matter paragraph referring to the situation. The audit opinion remains unmodified. Now let's talk about reporting when the doubt still remains. If substantial doubt is not alleviated and the disclosure is still adequate, the auditor must still issue an unmodified opinion, but include a separate section titled Substantial Doubt about the entity's ability to continue as a going concern. Again, I'm pretty sure that's the actual title. Now let's talk about the final one, communication responsibilities. The auditor must communicate in writing with those charged with governance when substantial doubt exists, whether or not it is alleviated. So they have to communicate either way. The communication should describe the conditions, management's plans, and the expected impact on the audit report. Is it going to alleviate it? Is it not going to alleviate it? Whatever the case is. Now again, those are the pillar topics. Those are the 5 main things that we learned from those 5 questions. So I hope this was helpful. Remember, in today's video, this is the YouTube version, we're only going to go over 5 questions, but SuperfastCPA CPA Pro members are going to get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other products and our other videos, make sure you check out becoming a SuperfastCPA Pro member because you'll get access to the full versions of these videos to get a little bit more help and a little bit more understanding. Now, the easiest way to learn about becoming a Pro member is actually by first going to our SuperfastCPA training webinar on SuperfastCPA.com and signing up for that. And that 1-hour webinar will teach you a lot about SuperfastCPA, a lot about our strategies, and it will give you a good path to becoming a Pro member if you watch that video first. So again, check out the webinar, check out becoming a Pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next one.